Hello, I'm Tom. I hope you're doing well. This is a guide to money. I hope it's informative, and I've kind of made this video so I'm aiming to talk to my younger self or be kind of like a lesson that I wish I learned in school. This video is timestamped, so feel free to skip ahead. And before we start, I have to say that I'm not a financial advisor. None of this is financial advice. But hopefully I come off as relatable. You know, I'm a 20-year-old guy. I'm not an expert, but I am very interested in money. But this video is just for educational purposes. Obviously, saving money is really important. Everyone knows that. But so many people just live paycheck to paycheck. You always want to have money in reserve in case of emergencies. This way, you're always okay for the inevitable financial curveball thrown your way. With savings, you're put in a position where you can help others, you can provide for yourself, you can provide for your family, and you're just in a safe place financially. And when curveballs do get thrown your way, you can react to them stress-free because you can just kind of buy your way out of it. And this will give you some kind of level of confidence. You can't become rich if you spend all of your money. And that's a simple concept, but a concept so many people don't really understand. But by spending all of your money, you will have no money. So you can't be rich if you spend all of your money. You'll have no wealth. So the trick is to save money, invest your money, and accumulate your wealth over time. By saving money, you are buying freedom and time in your future. With no savings, they're forced to chase money. If they encounter an emergency, they might have to rely on others, while someone with money has choices and time. It puts you in an advanced position. Inflation. I remember when a Freddo bar used to be 15p, and you might even remember it is a bit cheaper than that. But now, I go to the shops and they're 25p or even more. It's because of inflation. To put it simply, inflation is the average rate of which prices are rising. And this makes the value of our money go down. For example, if inflation goes up by 2% in a year and a loaf of bread costs £1, then that loaf of bread will then cost £1 and 2 pence. And this doesn't mean that the loaf of bread has become more valuable. It means that the value of our money has gone down. And this is because the supply of money has increased, so the amount of money in circulation has increased. The average yearly UK inflation in the last 20 years is 2.55%. So is inflation bad? Well, not exactly, because inflation is good for the economy when it is stable, so around 2%, 3%, 1%. As the value of money decreases, it makes people want to spend more money before they kind of lose buying power. Therefore, more money is flowing through the economy and going to businesses and shops and all that, which increases economic growth and business revenue. And this means that people are making more money and then they're spending even more money. However, inflation can get too high and negatively impact the economy. And I think I saw something, maybe it was a decade ago or a bit longer, and Zimbabwe, I think they had like an inflation rate of like 1 billion or maybe even 1 trillion. The currency just become basically invaluable. It is worth almost nothing. So to fix this, there is almost no fixable thing apart from scrapping that currency and just creating a whole new one. Inflation is bad for savings. When holding fiat currency, inflation will decrease its value. Essentially, you'll be losing money. This means by just saving and holding fiat, the spending or buying power of that money will decrease over time. So you'll be able to buy less with what money you have. Products, services and bills such as electricity bills will all get more expensive. However, you'll be able to cancel this out if your earnings and your savings kind of increase as well, like the same rate as inflation. So if your savings gain the exact same amount of interest that year as inflation, then it will cancel each other out and it will be like nothing happened. In conclusion, to protect yourself from inflation, your money needs to grow. And this primarily promotes people to invest, to sell their fiat for stocks and shares, and even cryptocurrency. And this will preserve their wealth, increase it over time, and kind of hedge and protect themselves from inflation. Interest rates. Typically, as inflation increases, interest rates increase linearly because it keeps the inflation rates stable. As you can see in this chart that shows UK inflation rate and interest rates from 1945 to 2011. Interest rates are used by governments to decrease inflation because interest rates make people save more and borrow less. Interest rates are essentially the cost of borrowing money. The good thing about interest rates are that savings accounts will increase their interest rates, so you'll make more money from just saving money. However, the bad is that interest rates will rise in everything that you borrow money for. So this is mortgages, car loans, business loans, debt interest, meaning you'll pay more money for them. Credit score. So everyone has a credit score. Essentially, it tells others how reliable you are at borrowing and repaying money. A low credit score might indicate that you are not very good at paying payments back on time. So if you want to borrow money, your credit score will be checked to decide how much you will be able to borrow and also the rate of interest that you have to pay it back. To get the lowest and best rates, for example, if you wanted to get a mortgage or you're borrowing money, so to have a good credit score, that will give you the best rates. To improve your credit score, you want to build a good credit history, and by doing this is basically you're just paying payments on time over time. A good way to improve your credit score, which I personally do as well, is to own a credit card and spend a small amount each month on, say, your shopping, and then pay it back on time or early. You know, a lot of people say that credit cards are really bad and you should never get one, but you can use credit cards to your advantage if you use them properly and you don't buy with money that you don't have. It can help if you just use a small percentage of the credit card as well, such as less than 30% of what you can spend on it. And this is called credit utilization. Investing. Disclaimer: none of this is financial advice. I'm not advising you to invest, especially in the current economic conditions. All the markets look terrible, but I'm not telling you to invest, okay? So do your own research. The purpose of this is just to educate. So since inflation exists, just holding money will lose you money, lose you spending and buying power. Therefore, investing can be a good passive way to make you money. It can make you more money than in a savings account in a bank, but it could also lose you money. I used to think that investing was a hard thing to do and you needed to be very smart. I also didn't know how to go about it. But in reality, it's actually really easy to invest. And all you really need to do is just do a little bit of research. The most popular investments are things called ETFs. And these things are like a collection of stocks, much like the S&P 500. The S&P 500 is just a collection of the top 500 stocks in the US. These investments are considered safe because instead of investing in just one company, you're invested into lots of different companies at once, but in a single stock. So for example, if one of these stocks went bankrupt and they just went out of business, the stock would go to zero. But you wouldn't feel it as much because you're also invested in another, 499 if there were 500. So you wouldn't feel the effect that much. But if you were just invested in that one stock, you'd lose all your money. So that's why it's considered safer. Between 2001 and 2020, the average yearly return for the S&P 500 was 7.45%. However, after taking inflation into account, the real return is actually 5.3%. From 2016 to 2020, the average yearly return was 13.95% or 11.95% with inflation. Statistically, it is better to hold stocks and shares for the long term rather than the short term. A lot of the biggest returns in the stock market's history, the biggest upside and the biggest downsides, just came within one day. The chances of making money in stocks vastly increases with the amount of time that you're invested in them. Basically, the most important advice I could ever give you is just the simple buy low, sell high. And it's very simple, but so many people, especially in crypto, they see it going up and they buy, and then it goes down. They see it, they buy when it's already gone up so much. This doesn't mean just buy low stocks because it doesn't guarantee that it's going to go up again. But when there's dips and stuff, much like crypto, it's good to buy at the bottom rather than the top. You can invest easily on platforms such as Vanguard. And I recommend Vanguard, and I've used Vanguard myself. I'm not sponsored. They do have a good, wide range of funds and ETFs. They're really good. So yeah, I recommend Vanguard. They're easy to use. Tax. What a great subject. What is tax? Tax is a mandatory payment to the government that comes straight out of your earnings. They are paid yearly, and the tax year goes from April to April. Taxes are also paid automatically when selling and buying goods, and this is called VAT tax. Taxes are also paid with special terms and rates when buying and selling things, such as in houses and real estate. When you see the wage of a job, it is not after tax, it is before. Therefore, when you see a wage, you'll probably be earning a lot less than that because tax comes out of it and will deduct a significant amount. This is something I didn't know when I was younger, and I was quite disappointed to find out about. Tax is used by governments to fund things such as the police and ambulance service, the NHS in the UK, buildings and infrastructure and maintaining them, the education system, money for the environment, the army, and loads of other things. There are different rates of tax in many different forms. The two main forms are income tax, and that is tax that comes straight out of your earnings, such as when you're working your job. And then there's capital gains tax, which is tax that comes out of investments after selling. Now we move on to cryptocurrency. Oh boy. Disclaimer, this isn't financial advice. The current crypto markets are looking absolutely shocking. So be very careful. If you don't know what you're doing, I don't recommend just buying. I recommend researching and truly understanding the cycles and knowing what you're doing before investing into cryptocurrency, because it's so volatile, which makes it extremely hard to make money from. But if you can make money from it, you can make a lot of money from it. So what is cryptocurrency? Cryptocurrency are essentially digital currencies that aren't made by official governments. Crypto has become increasingly popular since it was invented in 2009, starting with Bitcoin. Investments in crypto have made millions, but millions have also been lost. Many people think that cryptocurrency is the future of money. Many people will advise you to hodl or have diamond hands or hold your cryptocurrency for the long term, and if you don't, they might say that you have paper hands. This can be a good strategy, just holding, but also it can be unsuccessful since coins are not guaranteed to be here in the long run. And in a few years, coins might have completely collapsed and be worth nothing. Look at Luna. Luna was one of the biggest cryptos. It was in the top 10. One Luna token was worth $100, and then within a week it went to 1, and then within the next week it went to $0.0000, and it's insane. So many people lost their money. So many people thought this was the future, and it's gone within 2 weeks. So that's the risk people take when in crypto. Plus, you'll need the stomach to survive a lot of crashes when holding crypto. And I'm talking watching your money half in value within a week, or maybe even go down 90% and then rise 2,000%. This is just insane. So I would kind of disagree with the diamond hand strategy. I like to try and buy low and sell high. I'm currently aiming to buy cryptocurrency in this bear market. I'm planning to then sell and take profit as crypto goes into another bull market. I'm expecting this to happen around 2024, maybe a bit earlier, maybe a little bit later. But that isn't guaranteed, and it's all provided that a bull market actually happens, which I'm pretty sure it will, but again, nothing's guaranteed. We don't know what's going to happen with the economy between now and 2024. So one of the most important things to know is that the crypto market operates in 4-year cycles. This is because every 4 years, the supply of Bitcoin halves. Bitcoin is created by mining Bitcoin, and this is done by using very, very powerful computers to solve complex mathematical problems. This takes up a lot of computing power and obviously electricity. As of this video, there are around 19 million Bitcoin in circulation, and there are a maximum supply of 21 million Bitcoin. This means that once 21 million Bitcoin have been mined or created, no more can ever come into circulation. And this means that Bitcoin is kind of a scarce asset, much like gold. It will be the year 2140 when all Bitcoin have been mined, because of the halving of every 4 years, or around about that, the Bitcoin supply halves. When the supply of Bitcoin halves, but the demand stays the same, it usually pushes up the price of Bitcoin significantly. And this can push up its value and push Bitcoin into a bull market, which is what we've seen for the last 3 or 4 cycles. When people see the price of Bitcoin and crypto rising, it usually brings in new interest. And this causes more buying pressure and for the price of crypto and Bitcoin to usually rise even further. And then eventually for it to become very overvalued and very expensive. However, in the past cycles, this has caused Bitcoin to then crash significantly. A bull market is when the price is going up, because a bull, when they attack someone, they go like that with their heads. They hit them upwards. And a bear market is when the price is going down, and this happens because a bear attacks like that and pushes them down. The king of this market is Bitcoin. Bitcoin cycles in the past have influenced other cryptocurrencies known as altcoins to enter a bull market. Other cryptocurrencies have different purposes, aims, and use cases. However, most of them are kind of competing for the same spot, so only a few of them will actually last the test of time. People also like to invest in these altcoins because they have a smaller market cap than Bitcoin. The meaning of a market cap is the amount of money invested in it. And this makes them believe that they can make a greater amount of money and better returns, since it would be easier for an altcoin with a smaller market cap to double in size or triple in size. This is often true, but then it is just as easy to lose a significant amount of money as it is to gain. And some people can lose all of their money in altcoins, and we saw this with the Luna crash, from where it went from $100 to $0.0001 in a space of like a week or two. Doing lots of research into tokens before investing is extremely important. When the market crashes and begins a long-term downtrend, this is when the market is entering a bear market, where prices fall for a long period of time. Many investors who didn't sell are forced to sell. Many investors leave crypto thinking it is the end. However, the bear market can be the best time to purchase crypto at the lowest prices. Although this isn't guaranteed, I think it is quite likely that crypto will go into another bull market and Bitcoin will rise to a new all-time high in maybe the year 2024, which is 4 years after the last halving in 2020. It is also extremely hard to time the exact bottom of the bear market, the cheapest prices to buy. Buying at low, cheap levels still puts you at risk of big downside movements of even up to 50%, 80%, another 90%, and so on. A strategy used by many investors is called dollar cost averaging. This means to put in a little bit of money into a crypto or investment or stock every day or every week or every month, and then eventually you'll get a price of the average. So you take advantage of all the lows without having the complete risk of buying all at a certain place and then it going down even further and losing a lot of money. But that's all I have to say about that, really. I hope it is actually helpful and some people can take a lot of information from this video. If you watched this far, consider leaving a like and maybe a subscribe or a comment to let me know what you thought of this video. Thank you very much for watching. I hope it was helpful. Have a great day. I'll catch you in the next one. Bye.